after 20 September 1985, if you buy and sell a CGT asset, for example, land or shares, it is now in your tax return. You have to pay what is called capital gains tax. Now, 20 September 85, as we said previously, is the key date. Now, if you're a student studying capital gains tax, keep an eye out for dates in your exam paper. The dates are very, very important. So the legislation is not one page or one section, it's huge, it's hundreds of pages. And we now find the legislation in the ITAA 97, in the Income Tax Assessment Act of 1997. So it's not a separate act like the GST. And we're going to talk about a few sections from the CGT legislation over the coming series. Now, the other thing to note here is that if I make a capital gain, I will add that to my ordinary income. In other words, if I buy and sell some shares, I'm going to put that in my tax return and it will be added to my wages and my interest income from the bank. And I am going to pay tax on that at my marginal rate. Let's have a look at that. Let's look at this example. We have wages of 50,000, a capital gain of 10. Therefore, our taxable income is $60,000. Let's assume there's no deductions. We go up here, we can see we're in this tax bracket. We're going to pay 32.5% plus the Medicare levy on our capital gain. Let's say our wages this time are 25,000 and we have a capital gain of 10. What tax bracket are we going to be in? We're going to be in this one. So this time on our capital gain, we will pay 19 cents plus the Medicare levy. So it really depends where you are on this scale as to the rate of capital gains tax you'll pay. So the lower you are on the scale, the less tax you'll pay. The higher you are on the scale, the more tax you'll pay. Now, just to sum up a few things, if you bought an asset before 20 September 1985 and you still have it today and you sell it, you're very lucky. These assets are the best of the best. We like them. Why? If you bought the asset pre-20 September 85, you sell it today, there's no capital gains tax to pay. Now, they're called pre-CGT assets. If I bought an asset after 20 September 85, they're called post-CGT assets. Now, pre and post-CGT assets, we like pre-CGT assets the most. Secondly, section 102-5 refers to something called a net capital gain. That implies that we get all our capital gains for the year, so all our gains on the shares, we add them all up. If there's losses in there, we'll take them away, and then we'll end up with a final amount that goes onto the tax return. And we'll have examples of that later on in the course. Finally, if adding up all our capital gains and our losses for the year, we end up with a loss, and that can happen, then that loss is quarantined. The loss is not a tax deduction. It's a capital loss, and we can only use that against capital gains in the future.